We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gareth Soloway, President and Chief Market Strategist of InTheMoneyStocks.com and VerifiedInvesting.com. Gareth, thanks so much for joining me again today.
Hey, wonderful to be here, Tom. Great to talk again.
So, Gareth, I'd like to maybe start with the dollar. You know, it's really seems like it's been on fire here with 11 green weekly candles. So what can measured moves tell us about what the dollar kind of has in store for us ahead here?
Yeah, that's a great point. So we've seen 11 up weeks in a row, which in history is a very, very rare for the US dollar. In fact, the last time we had 12 up weeks, we haven't had 11 up weeks to exact, but in 2014, we had 12 up weeks in a row. Mm-hmm. And the dollar actually gained 8.33% during that period. And so it tells us that if that measure of that upside comes through, it'll bring us to about the 107.50 level on the DXY. And I don't know if you can give me chart sharing abilities, but what I can do is I can absolutely show and kind of walk through this measured move on the chart. But it is fascinating to think through. I mean, the dollar has been on a tear, and I think it's important to recognize that people all, you know, if you tuned in 6 months or 12 months ago, what was the narrative? It was de-dollarization, right? Mm-hmm. And everyone, dollar's done with, it's going to be going away. Since then, the dollar has done nothing but get stronger, right? So here we have it right here. So here's your 2000. Let me go back to this chart right here. 2014, we had 2, 4, 6, 8, 10, 12 up weeks in a row. Again, this is the weekly chart. And then we had a pullback. And then actually the dollar went on a pretty substantial run to the upside following that. So again, notice the measured move of around 8.33%. So if we go here to the latest move on the dollar, and we use that same measurement tool here, and I'll bring that up here, price range, we can see that an 8.3% move would bring us right up into this area here. There's also an upsloping trend line. So to me, it looks like anywhere between 107.50 to 108 on the Dixie is probably where we're headed. In which case, the stock market and gold and silver, they may be under some additional pressure here in the near term.
Mm-hmm. Yeah, it's interesting to kind of think about, let's say, from a fundamental view. I mean, obviously, people could argue that the fundamentals are extremely different now than in 2014, but you simply look at the chart and what it's telling you to kind of determine the direction forward, right?
Yeah, and that's really what it is human nature, whether it's subconscious or not, it always repeats or at least rhymes. And so, you know, the narratives will be different. The media will be telling you something, but ultimately charts behave generally the same, which is why patterns work out over time. Like you can literally go back and chart gold or chart tulips in the 1500s and the mania that evolved there. And you look at crypto in 2021 and you're like, wow, that was pretty much the same thing. And it's because, again, human emotion, greed, and fear replicates over and over again. So that's the beauty of charts. It takes the emotion out of it. You don't even have to turn on the news. And generally, you have a higher probability of success by doing that.
So, you know, Gareth, when we're looking at, let's say, establishing a position because you recognize that structure, let's say relatively early when you felt it was safe to establish that position, would you use a trailing stop or have a predefined stop of some point to make sure that if the chart doesn't follow your thesis, that you don't lose all the gains that you had made there?
Yeah, so you can do either one. And the thing is, number one is if you have a hard stop at some point, it should be when your thesis is invalidated, right? So again, you should be able to have a specific thesis. I'm buying this because of X, Y, and Z. And as long as that maintains, what I like to do is I like to dollar cost average into the positions, right? So again, doesn't mean you're going to pick the exact low. I very rarely pick the exact low on a stock or a commodity, but it's saying, okay, let me divide my position into sixths or fifths or tenths and buy 1/10, 1/10, 1/10, then it gives you this maneuverability. And then same thing on the upside, right? So if your thesis fails, that's when you technically should exit the trade. On the upside, once you're in the money, I recommend exiting slowly as well. basically take off, 1/10 here, and then you can move your stop to break even. Now you've ensured that it's a winning trade, right? Because even if you get stopped out on the remainder break even, you still have that gain from that first 1/10. And then as it goes higher, just slowly exit the trade on the way up. So you're getting some of the additional movement to the upside in profits. But if it reverses, let's say it reverses and you only got out of half your position, well, number one, you're only in half, so you've taken half off. And also it gives you the maneuverability to buy back in if your thesis is still valid, because we know markets don't go straight up or straight down.
Mm-hmm. Is there a way to, in some ways, analyze, let's say, the liquidity flows out of the stock market that would create demand for the dollar, or are there different mechanisms at work there?
Yeah, so I think part of the strength in the dollar is that, you have the U.S., which is on this kind of no landing economic data, jobs data is relatively strong. So, so the narrative here in the U.S. is that, hey, we're going to avoid a recession, while the rest of the world's kind of in a crappy scenario, right? We're seeing, China's a mess right now. Their economy's a mess. Europe's the same way, and many other places. So money, again, is rotating into the safety of the US dollar. And I think the bond market too. I mean, the bond market, the interest rates just keep going up, and it's sucking money out of the stock market, which again is a negative for the stock market. So the dollar's gaining some traction. I think some money's going into the US dollar, and then other money is going into the bond markets. And that's, again, taking money away from risk assets like stocks and crypto, which then brings them down. And to some extent, the strength in the dollar obviously affects the metals as well.
Mm-hmm. Well, that's kind of where I wanted to go next, Gareth, is thinking about, let's say, if we wanted to establish, if we thought the dollar was going to go down, and that becomes our conviction, is buying gold in a way a levered dollar short position?
Yeah, I think so. I think buying gold gives you the potential of the inflationary trade on gold and the safety of gold, meaning that when risk assets get panicky, people run to gold. And then also, again, a way to diversify away from the dollar in that you're holding this other asset, right? So if the Fed eventually goes back to printing money, you have something else besides US dollars. Because we know that, a dollar in the 1920s is basically down 90%, 95, 90+% in value from the 40s, let's say, to where we are now. So we know over time the dollar loses value. Now gold, again, you could argue whether it's behaved equally as well, but either way it gives you an alternative. Now a lot of people would say, hey, Bitcoin does that too. No, it doesn't. It's still a risk asset, still goes down with the stock market. I think eventually Bitcoin does do that, but really gold is the pure play at this point. And I think one of the things to recognize here is if we look at gold, and this is one of my favorite things to talk about, and let me bring up my chart to show this, is that I think gold's performing amazingly well. Like if we looked at that US dollar chart, 11 straight up weeks in a row. And if you look at the weekly gold chart, we haven't had 11 straight down weeks in a row, right? You've had some upticks here, even when the dollar has gone up. And to me, that's showing me accumulation in the metals market, specifically in gold. So again, I love this bullish pattern here. We're almost at the low end of this daily chart. If I go to the daily, there's a major trend line coming up that we're just about at here on the GLD or on gold. And again, this is a bull flag, and it doesn't mesh. And normally, the dollar goes up like it has, we should see gold having fallen much, much more than it is versus just being below $1,900 an ounce. And to me, that's accumulation. And by the way, we know that central banks have been accumulating gold. They're the ones that print money. They're the ones that probably have the best view of what they're going to have to eventually do. If they're buying gold, to me, that's a place I have to have at least some, investments in.
Mm-hmm. Yeah, I was going to ask you about that, considering how attractive T-bills have become, for example, with the higher interest rates. That typically means a lower gold price. So,
right,
how do we conceptualize the standing in gold right now? Is that because of that demand that's coming from central banks? Is that really the only explanation we really have at this point?
So, and you bring up a great point, right? So not only is it the strength in the dollar, but you have interest rates as high as they are, which gives people an alternative to the metals, right? It gives them a place to go and get really great returns historically, at least over the last 20 plus years in these T-bills, 5+%, even going higher these days. So again, it shows us that the performance of gold, yes, it's been sideways to down, but it's showing that accumulation. And we talked about the central banks. Okay, that's one. But then if you talk to a lot of gold sellers, a lot of demand is coming from retail, and retail is just clamoring for gold. And I think the thought process there is, why do people like Bitcoin? I mean, it's the same thought process. The only difference is the gold is the safer method to diversify away from a government that has 33 trillion of debt and climbing, as well as, we know the printing presses will ultimately have to be turned on again.
Mm-hmm. So, Gareth, could we look at the silver chart as kind of a comparison to how gold has held up, and if silver has had the same type of demand or characteristics that gold has here?
Yeah, and silver's done okay. I mean, in general, it's been a little bit more volatile, which silver does do, right? I mean, silver's generally more volatile, so you see the ups and the downs being much more dramatic percentage-wise. In general, though, the pattern is pretty much sideways to lower, just like it has been on gold. The only thing, again, that concerns me a little bit is that silver's breaking this trend line here today. We are trading below it right here, and that might open the door for us to move down towards this 20 and a half level here, which, again, if I zoom out, it's a longer term trend line going back to 2020. In fact, the March COVID lows connected through these lows in September of 2022. So there is an opening where we might see silver go down a little bit more here. The only way I could conceptualize that and kind of say, okay, well, why would maybe silver underperform gold? If we do start to see the economy starting to stutter, it may signal the industrial side of silver's weakness, in which case silver could underperform.
Mm-hmm. So, Gareth, do we have to break down, let's say, convincingly below that trend line to be able to really call that there is going to be a further breakdown?
You generally want more than just one day below, right? So sometimes I like to say it's like a game of chess with institutional algorithms and stuff. They like to break trend lines because they know people will jump ship, right? So you have stops that are being triggered. You have people saying, oh, it's broken down, let me exit my position. So I usually like to see at least one more candle to the downside to really confirm that breakdown. But it's definitely what I would consider in the warning stages right now of a breakdown. We just want to see what happens here in the next day or so.
Mm-hmm. And then if we could, Gareth, sorry to go back to the gold chart here.
Sure.
What would we need to, let's say, convincingly establish a breakout on that bull flag?
Yeah, so what you'd want to see is same kind of thing. So you want to see at least a close above, which would be kind of the alert that a potential breakout is starting. And then you want to see at least one more day up to really confirm it. So to basically showcase that it's not just a whip of a pierce of a level. Because also when you're drawing trend lines, one of the tricky things is that, my trend line could be off by a hair and that could make me think it's a breakout, but maybe it's really not a breakout. So by waiting for that second candle, it really kind of takes that, uncertainty away from the trade. But I think if we can break above this downsloping trend line here, which is right now around 1920, 1921, my guess is momentum takes over and we retest that all-time high pretty quickly. And historically, if you look at probabilities historically, the more you hit a high, and we've so far hit it 3 times, every time you hit it, you increase the odds of a move above that level. It's essentially the concept is, hammering on a door, right? You got to break down a door. I run into it once, probably not going to break it down, maybe twice, maybe not. By 3, 4, 5, at some point that door is busting down and I'm going to get through to the other side. So the same thing applies with charts.
Mm-hmm. So Gareth, if we could, can we move on to, let's say, a Nasdaq chart? It seems like it's finally starting to roll over after quite an impressive performance, really since the start of the year. So are we seeing that type of a breakdown here in the Nasdaq chart?
Yeah, so the Nasdaq, so one of the biggest things, and you can see I have a trend line here already where we're kind of into this lower end here. So there is a little bit of minor support, but this is certainly, just be clear, this is minor support on the Nasdaq. Might give us a 1 or 2 day bounce. We'll have to see. But the one thing that really strikes me is that if you look at higher highs and higher lows, that's what happened since October of 2022. That changed with this high in July and then this subsequent high in September. Now we have lower highs and lower lows. So in terms of a trend has now shifted to the downside, which is definitely a warning sign that more downside is coming. And by the way, I was just going to show you this too. This is a really good example of why I've never bought the narrative that we were going to go make new all-time highs in the near term, is because if you look at the chart on the Nasdaq and we flip over to the weekly, there's this pattern formation. We had this big move from COVID to the upside to the all-time highs. We then had this big pullback to October and then this subsequent high, and we're now pulling back. If you go back to the .com bubble, it's literally a replica of that, right? Look at this. Big move up from 98 October lows, epic move, big pullback, big bounce, and then look at what happens. We eventually roll over to the downside. So that to me has always been something where I'm saying, you know what? If you look at valuations that were achieved in 2021, I mean, GameStop, I mean, some of these stocks that went on these insane runs, which now have basically evaporated, very similar to the dot-com bubble, even big cap tech. I mean, Cisco was the darling of the dot-coms. It has never even gone back to that valuation. And here we had NVIDIA recently getting to these crazy valuation levels and so forth. So I would just say that, again, investors need to be very aware that this market is on borrowed time according to the charts. Now, it could change in a week or two, but right now it's sending warning signals.
Mm-hmm. Could that be another example of a measured move from past performance of that chart as well, Gareth?
Yeah, absolutely. Absolutely. And you can do even Fibonacci retraces and look at, what's the retrace, right? And again, I haven't done this recently, but it's interesting. The retrace in the from the move from COVID low to the high of the all-time high, and then the retrace in October was a 618 Fibonacci retrace, right? Mm-hmm. So interesting just to take note of that, to think that, okay, that meant, if you think about Fibonacci, that would signal a bounce. We did get this epic bounce. Now, the question is, do we start to roll back? And I would dare say we're probably headed back to the COVID lows at some point in the next year.
Mm-hmm. So, Gareth, when we think about, let's say, trying to understand that from a more of a 5,000 foot perspective as well, are there any indicators that we can look at to tell us, let's say, how hedge funds are positioning themselves at the moment as a way to understand how the smart money is anticipating the direction of this market?
Yeah, so I mean, I've looked at some stats recently, and it looks like hedge funds have aggressively started to exit the longs and short the market recently over the last couple of weeks. So I think, again, the writing is on the wall. The Fed has made it very clear it's higher for longer. Finally, the numbers, we're seeing that there's no rate cut until probably September of next year. And so, again, when you factor in higher for longer valuations in stocks, your models, all these hedge funds have models, and their models now have to take into account, which means a lot of these stocks are still very, very overpriced. Even an Apple is still very, very overpriced. And so you have those type of metrics that are telling us potential downside. And by the way, to be clear, markets will bounce too. So we will have big bounces. In fact, during bear markets, you get some of the biggest bounces. But ultimately, now that the trend has changed, I would start favoring that downside aggressively. And it looks like hedge funds are thinking the same way.
Mm-hmm. So what can we look at to understand the effect of interest rates now being at 5.25% to 5.5%? Or, do we still need some time to really see where those effects are going to be felt in the market?
So I think you're partially seeing the effects of these interest rates, right? We saw Silicon Valley Bank fail. I mean, there was a lot. I mean, these banks over leveraged themselves on bonds that were paying, 1% or so. And now all of a sudden, think about a bank that was paying interest of 0.1% on savings. And now there's alternatives. You can go to a money market and get over 5%. So money started vanishing or being pulled from banks, essentially a bank run. And that put a lot of pressure. We saw Silicon Valley Bank fail. And then you look at like the real estate market where, right now, unless someone has cash, there's almost no buyers for real estate right now. There's not sellers either, which is crazy. I mean, it's a frozen market because people that have 3% loans, they're not going to sell their house and have to take on an 8% loan. Mm-hmm. So it's people won't sell, which means inventory stays low, but also buyers are now very, very scarce. And, the next stage is forced selling. Airbnbs, if they start to have to be dumped because, they're not getting booked to be able to pay the mortgage payment, they're going to go into default. They'll be on the market. So I think this is the beginning of a bigger correction in real estate, but it's wild right now, man. It's the beginning stages. And my guess is, by the way, is that there are things that are broken already, but we don't know about them. The Fed probably knows. They see a lot more data than we do, but again, we just don't know yet.
Do you have any idea, where some of those areas are, Gareth, that you're considering something that could be broken that we're just not seeing yet?
Yeah, I mean, commercial real estate, we don't really know a lot about that. We know it's in a huge mess, and there's a huge amount of defaults out there. But it's not marked to market, right? So these banks don't really have to take into account massive losses. So I mean, those are major issues. I would also say that corporate debt, right? Corporate debt, you can look at these numbers, and there's a massive amount that's coming up for refinance. And now you have companies that got used to taking out massive loans at let's say 3% or 4% or even 5%, now a corporate loan is probably in the range of 10+%. And so this is going to put a huge strain on companies that are not profitable, that are looking to grow. It's going to be very hard to grow. And then that starts to ripple through the entire economy, right? So you now have less investment, less money to go around, and the economy will slow. And I think, again, to me, if you think back in 08 before the financial collapse, there was a period where, Bernanke came out and said, hey, we're not going to have a recession. And obviously we know what happened. Initially, the Fed was like, hey, guys, we're probably going to have a recession. And then recently they're like, no, we're not going to have a recession. To me, that's a kiss of death, man. Like, the Fed does not have the track record to back that up. And I have a feeling things are going to get very messy. And to be honest, last thing I'll say, and sorry to go on, but this market, this has been the most aggressive hiking structure ever in the history of the Fed, right? They've gone quicker than they've ever gone before. And to not think that it's going to break something significantly for the U.S. economy, I think is foolish. I do think COVID, there was a lot of savings there. It's helped us go this far, but we know retail now has $1 trillion in credit card debt. There's eventually going to be a point where it has to be paid.
Mm-hmm. Yeah, absolutely. And, considering right around those lines, considering that everyone has really been expecting a recession, yet it seems to have been forestalled for a lot longer than many thought. Is there data that shows us that we could actually be starting to tip into that contractionary territory?
There is, right? And you're right. It has been even longer than I thought. I think I underestimated the amount of savings and the willingness of the consumer to spend and run up credit card debt, even past savings from COVID. But I think there was just so much money in the system that it's lasted a lot longer. And I also think this rally in the stock market from October to now has really helped keep that afloat, which is going to be interesting in the coming months, where if the markets have stalled and start to come in, do people tighten their wallets essentially much quicker now because they're not seeing their 401k up 10% in the last few months or so? So I think that's going to be something major. Now, economic data wise, the jobs data has stayed strong, but I think jobs generally are a lagging indicator. Initially, you want to look at investments by business. How much money are they spending? They are cutting back. We have seen layoffs and stuff like that. So it's the beginning stages. It just certainly is taking quite a bit of time.
Mm-hmm. Well, with Powell signaling to the market that the Fed put has really come to an end, if the market cracks and inflation has met their target, won't there be any reason for them to ease? And is this all based around what the inflation data looks like if the unemployment data is such a lagging indicator as well?
Yeah, and I think the biggest thing here is will inflation crack, right? I mean, is it going to get below 3% to 2%? And I would argue that, you're seeing already oil is where it is, right? Basically 52-week highs on oil, putting pressure on inflation. And then you could say, okay, well, that's energy. It comes up, it goes down. But then think about, what we've seen in the labor markets. Not only is McDonald's paying almost double to the average worker, but now you have the UAW, asking for 40% pay hikes, right? That's all inflationary. And by the way, I'm all for people making more money, because I think it's important for us to look at both sides, right? These are people who didn't get raises very much, and that inflation has just crushed most people. So they deserve a raise, but the negative of getting raises is that it now increases money in the system, and then they spend more, which is inflationary. So it's really this kind of this, which one do you want? Like, is there a way? And ultimately, it's a financial system that, to me, comes back to being broken by the Federal Reserve and the government. Again, it drives me insane to think that the U.S. is paying $1 trillion in interest on debt that we really didn't have to have. Think about if they could invest that trillion back into the U.S. via programs, how amazing that would be.
Mm-hmm. Yeah, and it always seems kind of counterintuitive, considering they were the ones that implemented these policies, and yet Joe Biden is going to be joining the UAW auto workers on the picket line.
Yeah, and we know that's all. Like, it's nothing against Biden or whoever. It's all about publicity for the elections, right? So it just comes down to that, and it's one of those things where I've pretty much lost all hope for the government at this point, and it has nothing to do with Republican or Democrat. To be honest, I just think they're all a bunch of idiots, frankly, and it's not that they're idiots, right? It's that their goal is to get reelected in 4 years. Let's be honest, right? That's their goal. And so why do you ever want to do anything? Why would you ever spend your time to invest for the long term, which is what this country needs, when all you care about is 4 years from now getting enough votes? All you do is the short term. And we know when you get the short term pleasure, you pay for it in the long run, which is where we are now.
Mm-hmm. Yeah, I've mentioned several times on the show that many politicians are using the incentives of the system perfectly, really, the way
Yep.
that it's set up. And really, we shouldn't be expecting them to do any different considering how things are set up.
Yeah, you're right about that. It's from the ground up. It has to be rebuilt in the right way. There's no doubt about it.
Mhm. So, Gareth, are there parts of the world that you're particularly bullish on, or are we looking at this kind of looming recession for the world as a whole?
Yeah, there are, right. So I mean, and listen, it's not to say that if the U.S. collapses or has a big recession, it's not going to influence the globe and markets. But I think honestly, at this point, the U.S. will probably have higher inflation for longer. Maybe not that high, but at least enough to make it hard for the Fed to print money again as aggressively as they have. But like, I mean, I think you start looking at commodity laden countries, right? Like Venezuela, well, not Venezuela, excuse me, Brazil, right? So you're looking into South America. And I love this chart. It's borderline breakout on the EWZ. This is the Brazilian ETF. And, you know, if you look at where this market was in '08, where we are now, I mean, if you look at valuation wise, the US is like miles high from '08. And here you have a country that their stock market's essentially 1/3 of the price it was in '08. And so you start to say, okay, and then where is money? You know, value is in commodities probably more and more as we see higher inflation for longer. And something like Brazil looks attractive. And please understand the stock market's down today, and so is Brazil, right? So it's still going to see downside if there's panic, but it's probably going to outperform the US markets going forward.
Mm-hmm. And a big part of that is because it's a commodity producer. And can we kind of extend that thinking through other commodity producers, like let's say Australia and Canada?
I think you can, but I do also think that you want to make sure to look at the charts, right? So, you know, I'd much prefer a chart that has been decimated and I'm buying towards the lows versus if you look at a country that has it, but it's already gone up 10x in the last 10 years, you know, be a little skeptical that maybe the valuations are a little too crazy there.
Mm-hmm. So could this also, you know, looking at this from a bit more of a capital flow perspective, could this also be due to a liquidity issue or liquidity leaving the US stock market because of, you know, interest rates being attractive abroad as well?
Yeah, I think so too, and I think that's part of it. You know, needless to say, we've seen countries like China and even Japan, I think, has sold some of the U.S. Treasuries that they're holding. As again, there's kind of this attempt to structure the global order and not allow one country to be so dominant on the whole entire world stage. So I think that's part of it too. But I think more than anything, it's more about stocks and stock valuations and understanding that if the U.S. is not able to print like it has in the past, growth is going to be slower now going forward, which means less earnings growth. The valuations here have to come in versus lower valuations in other countries. I mean, if China just were to say, hey, we're not going to invade Taiwan, the Chinese stock market's one of the cheapest markets out there. It's amazingly attractive. It's just a little scary to get involved there because of the potential for an invasion of Taiwan. And so again, it's looking at other places, the valuations, and then obviously staying diversified.
Mm-hmm. Gareth, I'd like to return to talking about energy a little bit. You know, crude has been on a run here over the past couple of weeks. So how does that chart look? And do you factor in a drop in demand if or when the recession starts?
Yeah, so I mean, I am honestly more on the bearish side of crude oil here. I know there's so many people that are kind of super bullish. It's going to 100, it's going to 120. I think that's a possibility, but I just have some major resistance levels up here, and I'm still in the camp that we do see a recession. And the first sign of a labor market that starts to slow, I think you're going to see oil come crashing down very quickly. And just in terms of looking at trend lines, there's two trend lines converging right where we are today in the $93 a barrel level. You know, this high here and then this upsloping one. And this should be good resistance on oil. So again, for me, it's where, you know, I'm always very cautious when I'm entering these because I do understand momentum can carry it higher, but I do start nibbling a little on the short side on something like an oil here at these levels.
Mm-hmm. So, you know, let's say taking the other side of that, another chart that I'd like to look at is the uranium price, if we could, Gareth. You know, that's been on a fairly steady march higher as well. And if I'm not mistaken, it just hit a 12-year high either this week or last. So How does that chart look to you again, based on your trend lines?
Yeah. So one thing, just to kind of carry around the patterns and kind of go full circle with you. So you see this wedge pattern on the chart. This is a triangle, but it's known in this space as a wedge pattern. Now, simply go back to that chart we were just looking at. Let's go to the monthly chart of the EWZ. And this is kind of like, so when I say I use patterns over and over again, and it's because human nature tends to repeat or rhyme, this is like a prime example. And again, there's no guarantees, but same chart pattern, down off of its highs. And if we go back to URA, which is the uranium ETF here, that same sort of thing. Look at the breakout and look at that run it's had. Amazing run in uranium. And I think long-term, you have to remain a bull on uranium. I will say short-term, it's overdone here. It's had a huge run. I would be a buyer on a pullback. If I'm going to get into this, I have a level right around here, right around 24 on the URA, where if this thing pulled back, then I think that's where you start to accumulate. But I just don't chase things. So once they've run this far, I say, you know what? If it comes in, I'll pick it up. Otherwise, there's always another trade. But uranium, again, the thought process is that the U.S. and the world, we probably can't produce enough renewables in a short amount of time to, affect climate change and stop it. So you probably have to, at some point, we have to realize we probably need to go back to at least some nuclear in the near term here.
Mm-hmm. You mentioned something that I did want to touch on here before we wrap up, is talking a little bit about, like, let's say, investor psychology, and how and when you see a market like this, or oil, let's say, that you don't want to be chasing it. So do you have any rules around when you establish a position, and is it when it breaks a trend line and only at that time?
Yeah. So for me, it's about if I ask myself the simple question of, if I had bought this a day or two ago, could I have gotten it cheaper? And if the answer is yes, I don't buy it. I buy into support. So I want to look for charts that are falling into support. Or in this case, like if we look at a couple of these charts, right, once it breaks out, I wait. So I never see, if you look at this URA, right, it went up here, it broke out. And if you bought it here, I mean, yeah, now you're in the money, but it was already up. Look at how many days in a row it was up, and then it actually had a pullback. So once it breaks out, I'm much more likely to wait. I know it's the hardest thing to do because it gets emotional, right? You don't want to miss the run. You're like, oh, this is going to go nuts. But you'll find that, 7, 8 times out of 10, it always retraces here, and you can get it at a better price back to that same trend line that it just broke out. And then's the time. So you could actually get it at a better price by waiting and being patient. I know it's hard to do, but that's the rule for me. It's like, there's always another trade. And there's one thing I've always learned is, there's never been a day where I took a trade and there's like never another trade in the world. So worst case, I miss it. Okay, I've missed a million trades in my life, but I'd rather get a better price at using my discipline to get into that at the right time.
Yeah, that's exactly kind of the idea that I think is so tough for a lot of investors or traders that are just starting out, is trying not to chase and having that discipline around, establishing those positions.
Yep.
Perfect. Gareth, is there anything you'd like to add before we wrap up here?
No, I think for the most part, just, be aware that we're getting into a trickier time in the markets. The VIX has finally started to spike higher, which tells us that volatility is going to increase. And so it's going to test investors here. There'll be big bounces. There'll be great opportunities, but also great risk comes with great opportunity. So you got to know what you're doing. Be very, very careful. And again, look for those chart setups that make sense.
Excellent. There was one chart I wanted to go through with you, if we could, before we do, and that was Bitcoin. We mentioned it a couple times here. It has seemed to, bounce around and really consolidate, go sideways, and probably frustrate a lot of people that are really looking at that. How are you seeing the setup right now? And is this, really acting as a very risky or risk-on asset at this time?
Yeah, so it's kind of been a mix, right? We've seen it be weaker when the stock market was still rallying, and potentially historically it's been a leading indicator. So that could have been kind of telling us that the stock market was going to rally, or was going to roll over. And the reason it could be a leading indicator is because if you look at a risk curve, right, it's much higher on the risk curve. And so when money starts to get nervous, it gets rid of the highest risk stuff first, which would be like crypto. and then it kind of stays within the, let's say, the Magnificent Seven, which is less risk. And then once that's too risky, they start dumping the Apples and the Microsofts and kind of moving down. And eventually it's like bonds and the safer stuff down the line, which I think we're seeing now. So for the most part, I think you have to be aware that if the stock market continues down, probably crypto does as well. But we do see glimpses of it becoming kind of like a digital gold. Like when the banking crisis was occurring back in March, it actually had a big pop on Bitcoin. So I still think there's a risk that we actually head back lower and maybe even retest the lows in the 15,000 range. But long term, I still think this is going to be one of those golden assets that is probably a great part of a long-term portfolio.
Mm-hmm. And if we're looking at it from a, let's say, a cyclical point of view, has this, if we want to call it a crypto winter or this period of consolidation, has it lasted a lot longer than other cycles?
Not necessarily. I mean, again, and it's really tricky with crypto too, because it hasn't had that many cycles, right? There's been 3 or 4 bear markets in the history of crypto since 2009. But again, we're getting towards that point where people start to expect a bottoming out and then into the halving next year. There's, the 4-year cycle. We always hear the 4-year cycle. So the question is that going to repeat? And I'm honestly skeptical this time. And the reason I'm skeptical is because in every past cycle, the Fed's been printing money and easy monetary policy. And unless we get back to that real quick, you're not going to have that driving force. And so again, eventually I do think it rallies and has a tremendous rally, but again, you don't have the same factors in place. If you're doing a technical scientific study, it's not the same as the past cycles. So you have to at least be open to the chance that it doesn't repeat exactly.
Perfect. All right, Gareth, I really appreciate your time and walking us through all those charts today. Of course, you're available on Twitter at Gareth Soloway and at ITMS. Those are both great places to see more of your guys' work. And of course, InTheMoneyStocks.com and verifiedinvesting.com, right?
Yes, absolutely. Thank you so much for having me. Great discussion today.
Thanks, Gareth. Always a great time. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.